next, we're going to have the LP perspective, the limited partner perspective, perspectives on venture capital from the hand that rocks the cradle. Our panel moderator, Diana Frazier, was the co-founder of Flag Capital Management, one of the largest and most respected fund of funds in the industry. I'm going to let her bring up her panel and introduce them. And they're going to give different perspectives on being in the ecosystem of either an LP investing in funds, a fund manager, as well as entrepreneurs. Give it up, please, for Diana Frazier. Thank you very much.
Okay. This panel, this team has an amazing ability to pull together amazing speakers. We have, I calculated, close to 135, 140 years of experience on this panel here. And we've had two speakers talk to us about the exciting ecosystem. One, all respect to Ash, made it sound sort of easy despite the caveats at the end. We're the LP panel that's done it for 140 years, and so we're going to sort of be the naysayers a little bit. Not to dampen your enthusiasm, but to help you understand that this, as Scott said, should not be tried at home unless you're really prepared. It can be fun, but it may not be the best thing to do. I managed money for Mitch Kapor. I ran his family office when he was more wealthy and more well-known than Bill Gates. And one of the things I did with Mitch was he wanted to invest in everything he saw, and he is incredibly talented. But I said, Mitch, you're too nice. You say yes to everybody, and you're losing a lot of money that way. Why don't you give me some of it, and I'll manage it professionally, and then you have your pot of play money, and then you can do anything you want. So that's one way to skin that cat, is to consider this play money until you really know what you're doing. So let's meet these fascinating people here. We have Annette. Annette has about 26 years of experience. She started out as a CFO of a very powerful company in Latin America. She now is the family office manager and the chief investment officer for that family office. Their bios are online, but I'm just going to hit the highlights to remind you who's speaking. Then we have Andreas next. Andreas was the founder of Open English. He started teaching people English in major corporations, probably a TEFL type thing, and it evolved into a major company. He also has a venture builder now that's not in his bio, which is very important, and he has backed an online university for Latin America. Sean Petersen Sean's at the end in the red tie. He works for IFC, which is affiliated with the World Bank, and their global mission is to back private investments worldwide to encourage growth worldwide. And then we have Santiago in no tie. Santiago is one of the three co-founders of We. And We is a multifamily office that has had many predecessors, GenSpring, SunTrust, et cetera. And they finally went out on their own and started their own company. So you see, we have entrepreneurs, we have LPs, we have recipients of money, we have givers of money, and we have lots of experience. So let's hear what they have to say. The questions that were given to me by Tara have somewhat been answered by the first two speakers. And I think they've done a fabulous job of getting you excited about what's good about our business. So we're going to sort of go to the dark side, as I said, and talk a little bit about how hard this is. And where would we like to start? Let's talk about, let's each of us give us a quick two-sentence example of a pitfall. Let's start with Sean.
It's on? I didn't think so.
I don't know if it's on, but we'll get it on.
Is this on? Oh, well, I'll just speak loudly. There we go. Oh, okay. They're all on. I just don't hear it up here. I'm a technical investor. This is a good sign. Two things. First is I wore the tie for Dave because he wears T-shirts, so it's an average thing. Secondly, I would say pretty quick pitfall. I've been an angel investor. I've done startups as well in my background more than once. And I like to compare it to the movie industry where I briefly have worked. You can quickly fall in love because you find out your friends are looking at something that you don't really know that much about, but it seems like that's what everyone's doing. And I think it gets emotional. From that standpoint, I think one of the first things you shouldn't be doing as an angel, if that's what you're thinking about doing, is if you're just not going to be in the deal flow, so it's going to be hard for you to really create the context for those investments. So that's my first pitfall is don't get emotional, don't fall in love.
Okay.
Well,
Santiago?
yes, thank you. Well, in my case, I set up the company in 2000 from scratch, so I was very much doing what you are doing. It's not working. Yes.
Closer.
No? Yeah. Okay, no, I set up the company, the family office in 2000 from zero, in a moment that no one really was talking in Latin America, in my case, about family office. So I did it from zero. I went through the same process that you're doing, that you're going. I sold it in 2007 to a big corporation, and at the end, I realized that they couldn't do the right thing, and we bought it back 3 years ago with my other two partners. So is, as you say, don't get emotional, be very patient, and you will have many mistakes. You will in the beginning really lose track, but at the end, if you really keep working and investing and in the right place, you will succeed.
Yeah, thanks. So I would say, don't invest in things you don't know anything about. So after we did a big secondary at Open English, I started making some angel investments, and I just thought it would be nice to build a portfolio of different things that I knew little about. But especially as an entrepreneur, used to having a lot of influence over the outcome and being able to get very involved and with the management teams and how they hire, what they do, their mission, how they go about it. This was very different, right? All of a sudden you have a portfolio of things that you don't have any influence over. That I was an entrepreneur with Open English. I had 20-some angel investors. They still call me, hey, how's it going? It's hard to, you don't want to call the entrepreneur every week and see how they're doing if you invested $50,000, $100,000. So I decided as a result to go the venture builder route, which we'll talk about later. But again, I would say don't invest in things that you don't know much about.
Okay, Annette?
I think one of the pitfalls, particularly in our case, which we're a single family office, is being the lead investor or the single investor in something that you don't know a lot about. And somebody mentioned here that in many cases you should be behind an investor who has done this a long time. In our case, we have one of the brothers is an entrepreneur, and he hasn't wanted to get funding from the outside. And what that does is that, the premise has not been proven, and he just keeps putting money. So I think it's very, it's a very difficult thing to do. I also think that even when you know about the falling in love, when you know that something is not working, even to kill an investment is difficult and takes time.
Andres, you alluded to the fact that you went the VC route because of having these 20 investors. Well, I know some deals that have 100 investors. And Ash said that, well, you can do Q&A. Think of it if the entrepreneur is getting 100 questions or 20 questions a day. What does he have, a PR person to answer the questions? This sounds great at this level, but it's not as easy as it looks, because a lot of the best companies, there's serious adverse selection here, that the very best companies are going to go the VC route. So they try the VC route, and then they say, wow, look at all this help I'm getting. Now, that is not 100% true. Is that correct? There's adverse selection on both sides. But let's talk a little bit about that, because it's very important to understand which companies are going to go on Angel List. Ones that might not be big enough to get VC funding, therefore their idea isn't big enough, and how are you going to make money? Let's bat that around. We're doing this on the fly, guys. We did not practice this, so give them a little time to think.
No, it's one of the concerns as they were talking. Are the companies, and again, we get it a lot, and I try not to get offended, but we will get companies that say, well, we're coming to family offices because family offices are easier. So what they're telling you is you don't want to hear, they're just thinking that we're going to be less stringent in how we invest, and that may be true in some cases, but it's not true in all cases. But I think some of that may be happening in some of these platforms. They're not wanting to go to the more stringent VC criteria. But then on the flip side, it may be that the company is at a stage where it doesn't fit in those boxes. So it doesn't necessarily mean that they're, that there's not validity to them, but they just don't fit in those investing boxes that are out there.
Andreas, you seem like a very self-confident guy. Why didn't you go to something like AngelList or one of these other platforms? Because you're going to be bossed around by these VCs.
Yeah. So, this is one I struggle with, because I think that For example, AngelList is great for the ecosystem. It's wonderful. I think that 500 Startups is incredible for the ecosystem, this conference, the fact that we're talking about investing less money into more companies because more entrepreneurs will get to actually raise money, deal with investors, start something even if it doesn't work, learn, and that's what ultimately builds up the type of community that we need to be successful here in Miami. As an entrepreneur, investing my own money, that's a more challenging argument to follow, right? So I tend to find something that I'm really passionate about, that I know a lot about, and not just invest money, but bring in my circle of kind of syndicate of investors around, spend a lot more time on it, and kind of will it to success. But maybe it's because I'm more of an entrepreneur and failure was never an option, right? So you try to pick something that you're really good at and follow it through. So that's my perspective.
The other two gentlemen, one is really got more of a pro bono aspect to IFC. I don't want to demean your criteria. Your criteria is very high, but you're trying to change the world with private investments. You work for people who want to make money. These are family offices who come to you for make money. Have any of your clients used these things, and has there been success?
Well, the positive thing is that the people, the clients that we are working with, the family we are working with, they are tired of the public markets. So, and they are looking for other opportunities. They want to go direct. They want to invest in the real economy. The problem is, in many cases, they don't have the resources to do it themselves. So they come to us. And being honest, we don't have the resources to do full due diligence in every single transaction that comes to our desk. So we have really to be very selective, and we always try to do with someone else who has been really doing the full due diligence, unless the size of the transaction makes sense for us. That's why we usually don't get in the very, very early stage. We usually try to invest in companies that have already revenues, and then they have already a team, and we try to co-invest with them. But for us, it would be very difficult to really to invest in totally angel and first day companies.
So do you actively recommend against this for your clients?
No, we recommend to invest in the private markets.
In
the private markets,
okay.
We really want to be direct. We really are looking for opportunities, but we try to do it through first, or there is a sponsor who is going to be looking after the investments on a daily basis, and we could be really reviewing that, but we will not have the time to be reviewing 100 different investments, or try to get in a later stage, probably pre-IPO. Even though we will lose a lot of opportunities, we will not make the last back. We realize that, but it's a matter of being able to do it or not.
So Sean, what's your perspective from the global?
Well, I think on a global side, first I would like to point out we do only do private investing where we're going to make money. So as much pro bono sounded good, I just want to clarify. But overall, from my standpoint, I think I would take it more on the personal level. Is I am an angel investor in a few different companies, and it's very odd for me, having been a VC for a while and also having been the entrepreneur, where I know the interactions I'm seeking. And when you get to this angel level, there's 20 other people who look like you. And so whether it's online or offline, I don't know where that money is coming from. But it's a very different level of interaction. And so it's been hard for me to kind of take some form of a step back on those companies. So I think what Ash is working on is fantastic, and I think it would be great in some of the emerging markets that we invest in, because there's a complete lack of an ecosystem or a dearth of capital there. So I'm very supportive of anything personally that would do it, but I do agree that I find it hard when I've been in deals where certain angels have forced the managers to provide cash and create secondaries at a Series A level, and the company's not even generating cash. So there's challenges that get brought in by having 20 different players with 20 different mindsets, and so I don't know enough about the angel list to know if they make sure things like that don't get into the terms, and I think that would be good. But I've had a company get tanked because of one of our main investors, so at an early stage.
Have you had experience with big investors coming in and then trying to clean up the cap table and get rid of all these little guys? Is that what you're saying?
Well, that most certainly, but I guess as a more mature VC, I understand that, because when you go to get to a Series B, Series C level, and you have to do certain things with the company, you don't want to find out that there's 17 different people who have bizarre little aspects of rights. And so And that's a reason to create, I understand there's a need for a secondary, and there's that market kind of period between an A and a B and maybe even a C where you want to clean up the cap table. It's when people have unusual rights that prevent you from doing that that can create a lot of tension, is what I was referring to.
I've heard a criticism that some of these syndicates, this is not my opinion, I'm just stating what I've heard, that some of these syndicates are run by people who are wannabe venture capitalists and can't get a real job at a real venture capital firm, so they do this. Any comment? Oh, I think I see Dave with his hand up, but the... No, but you've created an amazing ecosystem. We'll use that word again in a minute, but I think Annette was going to say something.
No, what I was going to say is when Santiago was talking about, he works a lot with Latin American clients, and, our own family office is Latin American. I think one of the challenges that you have is that even though, we've heard it a number of times this morning, even though at this stage what you need to do is invest in a large portfolio of companies, when you have Latin American investors, many of which have made their money being entrepreneurs, their inclination is to really just put all their money on one thing. Exactly, put all their money on black. And it's really difficult to convince them that in order to be successful, you have to spread out that risk. And I think that's one of the challenges that we have. We do have a number of early stage investments, but it's nowhere near the portfolio that it should be if we were doing it professionally and if that was our main investment theme.
I remember once talking to a family when we first started back in '95. And I said to him, well, it's kind of like the 80-20 rule where, it might be only 20% of your money, but it takes 80% of your time. And the patriarch slammed his hand down and he said, young lady, you are wrong. It's 5% of our money and 95% of our time, and we've gotten nothing out of it. So we're going to go passive. We're done with this direct stuff. Let's talk a little bit about the ecosystem, because we're very excited to be here in Miami. This is my second time in Miami at a tech conference. I was over at Lightbox in December. A lot of exciting stuff. I mean, just amazing vibe at Lightbox of the people who are working so hard to come up with things. But again, the ecosystem might not be ready. And what can you do to help that? Because I started, you're going to find this hard to believe, in the venture business in 1981. And back then, the Research Triangle was going to be the next Silicon Valley. The Pacific Northwest was going to be the next Silicon Valley. Boulder, Colorado was going to be the next. Austin, Texas. None of them has really panned out. These are amazing areas that have some stuff going on, but you're talking 20, 30, 10 years later, they're still kind of, they had their run up and then they all fell off. At one point, DC area had like 50 VC funds starting offices over there. 49 of them are gone. So how can you avoid that here in Miami, learning from the lessons that other regions in the U.S. have had? Can we get some insight from our great panel?
Sure. I'll comment. For some history, when I got to Miami for the first time 4 or 5 years ago, well, I started Open English in my apartment in Caracas and quickly realized that that's the last or worst place on earth to raise money, and especially any venture money and things like convertible debt and discounts and caps. Those are kind of not very understood by investors down there. So had to move to Silicon Valley. Literally slept on my buddy's couch there and raised the first $2 million for the company. And I passed through Miami because Miami was such a natural place for a Latin American entrepreneur to stop by, and there seemed to be a lot of wealth here and a lot of people that were very smart, but there was a big disconnect between that wealth and tech investing, and there just weren't any success stories out of Miami. It was just an odd place to start a technology company, so I had to go to Silicon Valley, raise the money there, prove the model, and then move the company back to Miami where it really made sense to be, because our operations were all in Latin America. We have 250,000 students that have purchased our programs mainly in LATAM, so why fly from Silicon Valley to Miami down to Sao Paulo? It just didn't make sense, and the talent was here, so we lived that whole kind of transition of having to go somewhere else to raise money to come here. Now, I want to just that's changing, and it's changing really quickly. And I'm thrilled to see it. And I want to special thanks to Matt Hagman and the Knight Foundation. I think they've been one of the key players in weaving together the community. And now you have things like Endeavor, that is, seeking out high impact entrepreneurs to not really fund them, but give them the advice and the counsel and the mentoring they need to be successful. You have places to work like Venture Hive and the Lab. You have conferences like these that are really taking a step forward and educating investors in what to do, what not to do. Different opinions, but a lot of interest around the subject. And now more and more an active investor community that's out there doing deals. And there's startups that are Miami homegrown that have raised millions of dollars from angel investors, and we'll see how they do. And I'm sure some will work, some won't, and we'll learn along the way. But this is really happening, and it's happening at a pace that has been very, very exciting to witness and to be a part of. So that speaks a little bit to what's happening here.
Again, going back to my history, in 1981, the Japanese used to show up at the venture conferences with their translators in the back row trying to learn venture. And they still haven't quite learned it. The Chinese started from a dead stop, and they just learned it overnight. They just had a totally different mentality. So what's the difference? I heard Annette say that her family, which is a very prominent family, wants to put all their money on black. How can you get them to understand they have to diversify, to have that risk tolerance that's different to make this work?
I mean, I think one of the things that you said, I mean, you've worked for one of those families, is kind of, parcel out a certain amount so that it doesn't become such a big decision, and really make it a point to separate a certain amount of money and participate in, in the ecosystem of which you're part. I mean, we've been based in Miami for over, 15 years. And I think it would make sense to say, there's this much money, and then this we're going to do on a portfolio approach. And then, I think for a family office, the good thing is if they have deeper pockets is that you get to see a lot, and then when there's follow-ons, et cetera, then you can decide where you want to put additional money, and that's, one way to do it. I also think that by dedicating a certain amount of money, you really do your due diligence in terms of knowing everything that is out there, which is one of the difficulties that I have here, in part because I don't have the time to do it, but knowing everything that's out there rather than just picking from the people that actually make it to your door because they heard about you or got introduced. When you're doing it that way, it's hard to say, to really understand why you're saying yes to one or no to another. It might be just, it's harder to do. I mean, in the interest of full disclosure, at the beginning of the rounds, we passed on open English, which was a big mistake. But part of it was we didn't really know everything that was going on around, and we didn't know the rest that well. So,
I think Miami is changing a lot and has changed in the last 3, 4, 5 years, much more than the previous 30, and one of the examples with Andres and other people coming over, and at the same time, many savvy investors from New York coming down to Miami for many reasons. One of them, of course, is taxes. The second one is the weather, And we have improved very much the quality of people, and from Latin America there is a big interest about this, about tech, about new ventures, and they are trying to learn. The problem is too early. They are coming here, they are learning, they are listening, and I think there will be an opportunity to create a very big community here, but it takes time.
Yeah, it does take time, and one of the things I always say is you have to walk before you run. And what I find with family offices, because the bulk of our investors when we first started in '94, our fund of funds, were very big families, and they all wanted to run. And our goal was to calm them down and get them to learn that they had to learn about this asset class before they could do it on their own.
So I think you talked to just two different points. The first being on the ecosystem side. I can't speak as much to Miami, although I happen to think this is my first time in downtown Miami. I always have fun whenever I go to Miami. So I think it's a great place if you can create the ecosystem. Maybe I can move here. The second comment really though is when we think about it, the IFC, we look at the emerging markets, right? So I think you have some great people like Atomico is in the room here. I think Eric's here from Monashi, some other folks. I think that's an ecosystem that has, if you look into the 90s, there was people who talked about it and how it was going to take off and the government supporting, et cetera, et cetera. But I think now its time has probably finally come, and you're seeing key things like returnees, much like you saw in China, returnees coming in and leading companies. You're seeing that not necessarily the companies backed by, say, the development banks down there getting to be the best funds, but private money coming down. And if you compare again to China, there's kind of that watershed moment in the mid-2000s or so where all the US VCs finally started to come. That hasn't necessarily happened yet in Brazil, but I'm also not sure that that is what you're going to need to happen. I think that's what was needed in China in some ways. But China, as you mentioned, was really, it was just IDG, right? For like 20 years, just nailing it. And it was one guy running around there just about. So I think if we look at things like South Africa, where we've funded some groups, and you know what they're missing? They were missing the angels. They were missing the Series C guys. The PE people actually know that you have no follow-on capital, so you can imagine how that goes for your exit potentials. So I think from an ecosystem, it's important. Yeah, you're in Miami. In my mind, you're in the U.S., and a lot of that goes out of the way. But certainly when we look in the emerging markets, we need to see that. And then finally, I think Andres pointed out the legal aspect, the presumption that you've got these preferred structures even existing. They don't. You end up being very common-oriented. And when you're common-oriented, it becomes very difficult to get the specific minority rights that a lot of us are used to enjoying. So there is just legal framework aspects that you would need in place. Again, not relevant for Miami, but as an emerging market investor, that's what we think about. Thank you.
Okay, we have about 2 minutes left, so I'm going to ask you each to do a lightning 1 or 2 words to give the audience.
Wow, get to hear from me again. I'll just say one thing. Work for a great family is one of my first VC experiences, and what they did, and I thought was very prudent, is they had a business plan about what they were going to do. I know that might sound stupid, but some people aren't thinking like that. And then they also decided what's the one thing that they really narrowly wanted to focus on and just keep learning in that space. I don't mean it didn't mean they could invest outside of that area, but they became thought leaders in really only 18 months in a particular area. And anyone can do that if they take the time. And that would be the one takeaway.
Okay, so your 2 words are plan and focus.
Our would be that if you really want to focus to prospect clients in Miami, investors in Miami, we are dealing with Americans and domestic market and international market. So you have to be ready to have vehicles to invest for both of them. So set up the legal structure that makes sense for an offshore client and for a domestic client.
Okay.
I would say get involved locally, and Annette is a great example. So I think when I went and pitched Forrestal a while ago, this was like not something that they were really thinking about. But now Annette is here on this panel. She's on the advisory board of a company called My Ceviche with me. We get to see each other all the time and share, experiences and ideas. You're a mentor for Endeavor, and so she knows everything that's happening. And as a result, she can more easily identify those opportunities when they come.
Okay, so network is your 1 word.
Yeah, and support and help, because she's actually spending a lot of time helping companies.
Yeah, they say venture capital is an apprenticeship business, so.
Yeah, I mean, I think on that, try to learn by investing alongside people that have been doing it for a long time. I mean, one of the only early stage investments that we did it alongside a large corporate who has, a corporate venture arm. Another way that you've mentioned is, invest in funds that are investing in the areas that you're interested in, and that gives you a very good ability to see what's happening before you put your money directly yourself.
So we're out of time, and the panel will be around. I think Sean's here till 3. I'm probably here till 2. And I don't know about the rest of you, but feel free to come up and ask them questions.
Thank you.
Thank you.
Thank you.